50-week high, the highest level since Feb 27. So let's get in perspective on all of this. We've got Dhawal Dalal, CIO Fixed Income at Edelweiss AMC, joining in on the show, and also with us, Lakshmi Iyer, CIO Fixed Income and Head Products at Kotak Mutual Fund, joining in. Both of you, good morning. Thanks so much for joining in. Lakshmi, if I could kickstart the discussion with you. You know, the system liquidity is in a deficit of over 1 lakh crore rupees. That's the recent most figure. What is your own assessment of the system liquidity now, and how is it that you're shaping up ahead in the times to come?
See, the fact that we have seen two INR FX swap of $5 billion each, and despite that, we have seen a very recent open market bond purchase announcement suggests that there is some tightness which still persists in the banking system. Week on week, if we are tracking the currency in circulation, which is the money which is lying with the public at large, that number is on the increase. And I think it's a combination of these factors which are aggravating the tight liquidity in the system. And my sense is that if I allude to the monetary policy statement in the last decision, I think there are all tools available to be able to inject liquidity, whether it is transient liquidity or durable liquidity. We will need that because bond yields don't seem to be stopping their northward journey, whether it is the very short end of the yield curve or the long end. So I think the reflective sentiments in the bond markets clearly suggest that much more needs to be done in terms of liquidity injection.
You see liquidity improve given RBI's forex swap and that $5 billion announcement coming in, and do you think that's going to really further OMOs?
Oh, sorry. Our analysis suggests that this year, like last year, the Reserve Bank of India is likely to conduct a series of OMO in order to inject liquidity, durable liquidity in the banking system. Our initial assessment is that the Reserve Bank of India's total open market operations bond purchase could be to the tune of as high as $30 billion. I think the part of the reason is that in order to achieve economic growth of about 12% on nominal terms, and assuming that the credit growth continues to remain between 15 to 17%, I think the Reserve Bank of India will have to inject liquidity given the recent trend in increase in currency in circulation, as well as the amount of net borrowing which is going to be done by both the government of India as well as states, and the demand supply dynamic of that suggests that RBI will be in the market for most of the year.
Okay. Lakshmi, let's get in your take, because, you know, the Bimal Jalan committee is going to peg the RBI's excess capital at close to 1.3 lakh crore rupees. How do you see RBI's excess capital transfer impacting the overall liquidity? This is, of course, only according to reports.
No, that's true. As I said, you know, there are multiple ways to provide liquidity. It may not be, when, we've seen $5 billion plus $5 billion. So we've seen totally about 70,000 crores come in. The first OMO of the season of the financial year has been announced. And of course, you have CRR, but CRR does not seem to be an immediate tool which the RBI may want to invoke. So obviously, more the tools, the merrier in terms of being able to assuage the system that we are observing the market and we are willing to provide liquidity comfort. And one observation which I want to make here is that if you see globally, and from the time we have seen rate cut in the country till date, yields from very short end, maybe 2-month segment to the 10-year and 12-year segment and the beyond in government bonds have actually inched up by 25 to 30 basis points. And globally, if you see specifically the US, the yields have actually come down. So I think the rate cuts and your allied transmission, if you have to marry those two requirements, it is important that the bond yields in our country are anchored, given that inflation expectations are not very high at this point in time. So that is obviously one window. I don't know how this this capital excess will actually find its way into the system. We need to wait and see the finer details, but I think there can be no stone unturned to ensure that there is system liquidity available.
Sure. Dhawal, let's get you in on that as well. But along with that, since Lakshmi just touched upon inflation as well, do you see perhaps, higher oil prices, leading to higher inflation, perhaps putting pressure on the yield and overall macros going forward?
Well, initial reaction, yes. If the oil continues to remain at 75 or higher on sustained basis, it will have a negative impact on the headline inflation, and perhaps while the Reserve Bank of India has reduced their inflation expectation target by on average 40 basis point in the last policy, I believe that they will be compelled to look at the recent sustained increase in oil price in the next policy to see if it's making any adverse impact on inflation going forward, and more importantly inflationary expectations that Reserve Bank of India has a lot of weight in their analysis. But apart from that, your first question on the rates, I believe that the liquidity is something that the Reserve Bank of India is keenly following. And I think the expectations that the Reserve Bank of India will transfer some amount of reserves, I guess if the government of India uses that money to recapitalize banks, to that extent I think it will be liquidity neutral. But if the government of India decides to use that money for expenditures, then it will add to the banking system liquidity on aggregate.
Okay. Lakshmi, the recent NBFC crisis, FMP is not honoring fully. That seems to have impacted investor confidence to a great extent. What do you think the steps what do you make of the steps rather that have been taken by the mutual fund industry in order to address some of these issues?
See, the corporate bond market by and large is not very liquid, when you compare it with the sovereign bond market. So I think as a first measure in general, when something like this happens, you don't know what be the potential impact. So the first port of call usually is to increase liquidity across the portfolios, and also given the fact that yields are rising, I mean that's just a fallout of it, you also get probably better opportunities to redeploy these monies. The good part is that the outflows which happened in the month of March at the industry level, which is usually the year-end phenomena. In case of March, it is quarter-end, month-end, year-end, everything together. Those flows are broadly back into the system, not entirely 100%, but a good chunk of that has actually come into the liquid category funds, followed by the ultra-short and money market category. So therein lies an opportunity, given that the yields have risen, to be able to buy some of these quality assets to increase the overall yield on the portfolio, because even good quality high grade assets, the yields have inched up by 20 to 30 basis points. Investors and by and large, what we are observing is that in line with their investment horizon, we still continue to see positive flows and positive net sales, whether it's for the industry or it's for us, into these categories, including the short-term category. So I think this is an opportunity for money managers to cherry pick quality assets, of course keeping into consideration that the overall environment of liquidity is a little bit tight as of now.
All right, Lakshmi, Dhawal, thanks so much for joining us on the show today. Good to get your perspective on the entire liquidity scenario and the way forward as well. Thanks so much for joining us.